Gold often moves before stress becomes obvious in markets. Its signals appear quietly, without headlines or urgency. Early movement reflects subtle changes in risk perception. Stocks usually react only after those changes spread. When confidence begins to thin, gold absorbs cautious capital first. Investors hedge quietly rather than exit risk assets outright. That hedging phase feels rational and controlled. Stocks remain calm while gold starts moving. Markets tend to dismiss early gold strength as noise. Short-term explanations focus on technicals or temporary demand. Those explanations miss the behavioral shift underneath. Gold responds to behavior before narratives form. Stocks depend on earnings optimism and liquidity confidence. When either weakens slightly, momentum stalls. Stalling does not trigger panic immediately. Gold benefits from that pause. Central bank uncertainty often triggers gold's early move. Even small doubts about policy effectiveness matter. Markets price uncertainty faster than outcomes. Gold becomes the first outlet for doubt. Inflation expectations influence gold before they affect equities. Subtle expectation changes alter protection demand. Stocks require clearer confirmation to react. That delay creates divergence. Institutional investors rebalance portfolios incrementally. Small adjustments accumulate without headlines. Gold reflects those adjustments early. Stocks lag until flows become visible. Equity volatility can stay low, while internal positioning shifts. Calm indexes hide defensive behavior. Gold reveals that behavior sooner. It acts as a pressure gauge. Gold's early move is rarely dramatic at first. It advances steadily rather than explosively. Steady movement signals conviction without urgency. Stocks ignore steady signals longer. This pattern repeats across cycles. Gold senses change. Stocks confirm it later. The gap between them carries information. Most investors miss the gap entirely. Gold strengthens when investors begin questioning forward assumptions quietly. Those questions do not require answers immediately. They require optionality and protection. Gold provides that option before stocks respond. Stocks often rely on consensus confidence to move higher. When consensus weakens slightly, prices stall rather than fall. Stalling feels like stability. Gold reacts to the weakening beneath the surface. Policy signals rarely arrive with clarity. Mixed messages create hesitation rather than conviction. Hesitation shifts capital towards safety. Gold absorbs that shift before equities notice. Early gold rallies are often dismissed as defensive overreactions. Defensive positioning feels unnecessary until it is. By the time it feels necessary, gold has already moved. Stocks respond later under pressure. Equity investors usually wait for data confirmation. Data arrives after behavior has already changed. Gold prices behavior, not data. That timing difference explains the lead. Liquidity conditions also influence gold's early move. Subtle tightening reduces risk appetite quietly. Reduced appetite does not force selling immediately. Gold benefits from reduced enthusiasm first. Gold attracts capital seeking balance, not escape. Balance adjustments feel prudent rather than fearful. Those adjustments accumulate gradually. Stocks reflect them only when accumulation becomes visible. Internal market breadth often weakens before indexes decline. Weak breadth signals selective caution. Gold responds to selective caution earlier. Indexes mask it longer. This lead-lag relationship repeats because psychology repeats. Human behavior shifts before prices collapse. Gold captures early psychology. Stocks reflect later emotion. Understanding this signal requires patience rather than prediction. The signal unfolds slowly. Its value lies in timing, not drama. Gold speaks first, quietly. Gold often reacts to uncertainty in duration rather than direction. Markets may still expect growth, but timing becomes unclear. Unclear timing weakens commitment. Gold benefits from hesitation about when outcomes arrive. Stocks depend on confidence staying synchronized across participants. When confidence fragments, momentum slows. Fragmentation does not trigger headlines. Gold detects fragmentation early. Central banks influence gold indirectly through credibility. Even without policy changes, credibility shifts matter. Markets price credibility continuously. Gold responds before equities reprice expectations. Fear does not appear suddenly in professional portfolios. It emerges as risk reduction framed as prudence. Prudence feels rational and unemotional. Gold absorbs prudence quietly. Equity markets often assume policy backstops remain reliable. Doubt about backstops alters behavior subtly. Subtle doubt reduces aggressive positioning. Gold moves on reduced aggression. Inflation persistence strengthens gold's early signal. Persistent inflation changes long-term thinking gradually. Gradual changes alter allocation preferences. Stocks require sharper confirmation. Risk models rebalance automatically as conditions drift. Small parameter changes shift weightings. Gold receives incremental inflows. Stocks adjust later through price. Gold rallies during periods of narrative fatigue. Repeated explanations lose persuasive power. When stories weaken, behavior shifts. Gold responds to weakened storytelling. The lead is rarely visible on short time frames. It becomes clearer across weeks or months. Patience reveals the pattern. Impatience misses it. This phase reflects preparation, not prediction. Preparation values resilience over returns. Gold aligns with resilience. Stocks follow once preparation becomes necessity. Gold often rises when confidence in forecasting weakens. Forecasts rely on stable assumptions about growth and policy. When those assumptions wobble, commitment fades. Gold benefits from reduced reliance on forecasts. Stocks usually react after confidence erosion becomes visible. Earnings guidance softens or expectations narrow. Narrow expectations stall momentum. Gold moves earlier, before guidance changes. Early gold strength reflects capital-seeking optionality. Optionality matters when outcomes feel uncertain. Investors prefer flexibility over conviction. Gold provides that flexibility quietly. Equity markets struggle when leadership narrows. Fewer stocks support index stability. Narrow leadership signals fragility. Gold responds to fragility sooner. Policy pauses often matter as much as policy actions. Pauses suggest uncertainty about next steps. Uncertainty encourages defensive balance. Gold absorbs that balance adjustment first. Gold demand rises when real returns feel constrained. Even modest inflation pressures matter psychologically. Purchasing power concerns resurface quietly. Gold reflects those concerns early. Stocks depend on participation breadth to advance. When participation thins, rallies lose durability. Loss of durability is gradual. Gold reacts to gradual loss sooner. Institutional portfolios rebalance continuously, not suddenly. Incremental rebalancing rarely makes headlines. Gold captures incremental shifts. Stocks lag until shifts accumulate. Gold's lead is not predictive certainty. It signals rising sensitivity to risk. Sensitivity changes behavior. Behavior eventually moves prices elsewhere. This stage rewards observation over action. Action feels premature without confirmation. Observation preserves context. Gold's early move provides that context. Gold often strengthens during periods of quiet portfolio defense. Defense does not mean fear. It reflects awareness of asymmetry. Gold absorbs awareness before stocks react. Equity markets favor optimism until optimism becomes costly. Small disappointments reduce tolerance for risk. Reduced tolerance slows buying pressure. Gold benefits from lowered enthusiasm. Inflation narratives influence gold before they pressure equities. Subtle persistence matters more than headlines. Persistence reshapes expectations gradually. Gold reacts to expectation drift. Central bank credibility matters, even when policy remains unchanged. Credibility erosion alters behavior slowly. Slow erosion redirects capital defensively. Gold reflects credibility shifts early. Stocks require visible catalysts to reprice meaningfully. Gold responds to invisible catalysts like doubt. Doubt accumulates without announcements. Accumulation precedes equity response. Gold demand rises when diversification assumptions are tested. Correlations shift quietly before crises. Quiet shifts prompt hedging. Gold receives hedging flows first. Equity investors often mistake calm for stability. Calm can coexist with internal caution. Internal caution limits upside. Gold reveals caution sooner. Risk appetite fades in stages rather than collapses. Each stage reduces exposure incrementally. Incremental reduction moves gold steadily. Stocks respond only at later stages. Gold's role as a signal depends on patience. The signal unfolds slowly. Short-term focus obscures it. Long-term observation reveals it. This phase marks transition rather than conclusion. Transitions favor resilience over growth. Resilience attracts capital. Gold embodies resilience early. Gold often leads when markets begin prioritizing protection over progress. Progress requires confidence in future conditions. Protection responds to uncertainty about those conditions. Gold reflects that shift before equities react. Stocks usually follow once caution becomes unavoidable. Earnings expectations soften or liquidity tightens visibly. Visible changes force equity repricing. Gold has already adjusted by then. This lead-lag dynamic repeats because behavior repeats. Investors hedge quietly before they sell. Hedging feels responsible, not fearful. Gold captures responsible caution early. Markets rarely announce transitions clearly. They reveal them through relative performance. Gold outperforming while stocks stall is one such reveal. The reveal is subtle but consistent. Understanding this signal requires resisting noise. Headlines focus on outcomes, not preparation. Preparation happens in silence. Gold moves during that silence. Stocks follow when silence breaks. By then, opportunity shifts toward preservation. Late recognition feels obvious in hindsight. Early signals only reward patience. This pattern does not predict timing perfectly. It highlights changing sensitivity to risk. Sensitivity alters capital flow direction. Direction matters more than speed. Gold's early move is not about fear alone. It reflects uncertainty, hesitation, and optionality. Those emotions appear before panic. Stocks respond later under pressure. Most investors miss this signal because it lacks drama. Quiet movement feels unimportant. Importance becomes clear only later. Gold moves first because behavior moves first. The lesson is not to chase gold or avoid stocks. It is to observe relationships carefully. Relationships reveal shifts before headlines. Gold often speaks before markets shout.